If you own multiple dental practices, here is a critical question. Do you actually know which location is the most profitable? Not which one produces the most, not which one collects the most, but which one generates the strongest margin. Because production does not equal profits. And if you're not comparing locations correctly, you could be scaling the wrong model. Today, I'll show you how to properly compare profits across locations and the common mistakes that distort the numbers. Here is what we often see with multi-practice owners. They compare locations using production, collections, bank balances, or just how busy it feels. But those metrics don't measure profits. Worse, financial reports are often categorized differently per location, missing standardized payroll separation, not reconciling monthly, not structured the same way. So when you try to compare location A to location B, it's not an apples to apples comparison. And when comparisons are distorted, decisions are distorted. You might invest more into a location that looks strong, but actually has weaker margins. That is dangerous. Let's simplify this. Imagine two locations. Location A, revenue $300,000, overhead 72%, net income $84,000. Location B, revenues $240,000, overhead 63%, net income $88,800. At first glance, location A looks stronger. Higher revenue, busier office, more production. But location B is actually generating more profit with lower revenue. Why? Because margin matters more than volume. Profits matter more than production. When comparing locations correctly, you should look at collections, overhead percentage, net income, payroll percentage, and profit margin, not just the top line collection. Before you compare profitability, reporting must be standardized. That means same chart of accounts across all locations, same payroll categorization, same lab and dental supply classifications, same expense grouping, monthly bookkeeping completed. If one location includes lab and dental supplies and another separates it, your overhead comparison is already distorted. Consistency creates clarity. Without consistency, comparison is meaningless. Let's say location A shows 75% overhead. Location B shows 68% overhead. You assume B is more efficient, but after standardizing categories, you discover location B had $18,000 of equipment expense misclassified under assets instead of expenses. Now, its real overhead is 74%. That's a huge difference in perception. Without clean, standardized financials, you're making decisions based on inaccurate information. And in multi-location ownership, small percentage differences compound quickly. Here's what you should do. For each location, review monthly total collections, total overhead percentage, clinical payroll percentage, dental supplies percentage, and net profit. This should be all done side by side for all locations. Same structure, same categories, and the same time frame. This gives you clear visibility into operational efficiency for each location, insight into management performance, early warning signs of reduction in profits. You're no longer guessing, you are diagnosing. Here is why this matters for scaling. If you're planning to add another associate, add a new location, bring in outside investors, you need to know which operation model is the most profitable. You don't replicate the highest revenue model, you replicate the highest profit model. Scaling a location with lower margin multiplies inefficiency. Scaling a location with higher profits multiplies profitability. That is a critical difference. So here's the takeaway. If you own multiple dental practices, stop comparing just revenue. Start comparing profits. But before you do that, make sure reporting is standardized, categories are consistent, financials are reconciled each month, you are reviewing percentage-based metrics, not just dollars. Production tells you activity. Profits tells you strength. And strength is what you scale. Clear numbers create clarity. Clarity allows strategic growth. If you're operating multiple locations and you're not reviewing standardized side-by-side monthly profits, that's the first place to start to improve. On this channel, we focus on helping dental practice owners build real financial visibility, especially those scaling beyond one location. If this was helpful, subscribe. Clear numbers, better decisions, higher profits for dental practice owners. I'll see you in the next one.